Trading currency pairs. So what actually takes place when you are trading on the Forex market? The concept is a bit tricky to grasp because when dealing with Forex markets, you aren't trading anything tangible. But just like trading stock involves the buying and selling of a piece of company, Forex trading involves buying a piece of a country's currency. The price of the currency is a direct reflection of what the market thinks about the current and future health of the economy of that particular country compared to other countries' economies. By buying a British pound, for example, you are really buying a share in England's economy. When the price of the pound changes in relation to another currency and you have correctly bet on the direction, you have made a profit. If you buy a soccer ball in London and pay 10 British pounds, using a conversion of $1 to 2.5 British pounds, you have now paid $4 for the soccer ball. If you take it home to Chicago and want to sell it to your neighborhood soccer club and the conversion rate is now changed to $1 equals 3 British pounds, your ball has lost 0.50 British pounds per dollar, and the $4 you thought you spent on the ball is now really only $3.33. Your soccer ball has lost value, and if you want to make a profit on your sale, you need to pump up the asking price. Currency symbols are always listed as 3 letters, where the first 2 letters identify the name of the country, and the third letter identifies the name of that country's currency. USD stands for United States dollars. NZD stands for New Zealand dollar. The 4 major pairs are EUR/USD, USD/JPY, GBP/USD, USD/CHF, which involve the euro, US dollar, Japanese yen, pound sterling, Australian dollar, Canadian dollar, and the Swiss franc. Those currency pairs that are not paired versus the US dollar are called crosses. Some examples of crosses are AUD/NZD, Aussie dollar versus the New Zealand dollar, EUR/AUD, Euro versus the Australian dollar, EUR/CAD, Euro versus the Canadian dollar, GBP/JPY, British pound versus the Japanese yen. In addition, there are the following 2: XAU/USD, gold, XAG/USD, silver, because gold and silver are actual commodities and can also be considered commodity currencies. These currency pairs are considered by many to drive the global Forex market and are the most heavily traded. Although it is widely regarded that the major pairs consist of only 4 pairs, some believe that the USD/CAD and USD/AUD pairs should also be regarded as majors. These 2 pairs can be found in the group of pairs known as the commodity pairs. The first currency of a currency pair is referred to as the base currency, and the second currency is called the quote currency. The currency pair shows how much of the quote currency is needed to purchase 1 unit of the base currency. All Forex trades involve the simultaneous buying of one currency and selling of another, but the currency pair itself can be thought of as a single unit, an instrument that is bought or sold. If you buy a currency pair, you buy the base currency and sell the quote currency. The buy price represents how much of the quote currency is needed for you to get 1 unit of the base currency. Conversely, when you sell the currency pair, you sell the base currency and receive the quote currency. The sell price for the currency pair represents how much you will get in the quote currency for selling 1 unit of base currency. Here's an example. A USD/EUR currency pair is quoted as USD/EUR equals 1.5, and you purchase the pair. This means that for every 1.5 euros that you sell, you receive US $1. If you sold the currency pair, you would receive 1.5 euros for every US dollar you sell. The inverse of the currency quote is EUR/USD, and the corresponding price would be EUR/USD equals 0.667, meaning that US 0.667 would buy 1 euro.